Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with building the right portfolio. Now this year, we have seen significant repositioning of investors away from US dollar assets, disrupting the long-held US exceptionalism narrative. Despite rising US bond yields, the US dollar has fallen alongside with equities. On the trade-weighted basis, the dollar is now down 10% this year. Traditionally, rising yields would boost the dollar, but concerns about US policy outlook and its implications for the dollar's global role have contributed to this divergence. The theory of the dollar smile suggests that the US dollar should rise in strong expansions and recessions in the US. In periods of economic growth and rising earnings, the US dollar will benefit as investors buy US equities and other cyclical assets. Meanwhile, in times of market stress or looming recessions, the US dollar would also rally as investors flock to safe haven assets such as US Treasuries. Only when there is a synchronized, robust global growth environment, such as in the 2000s, the US dollar would weaken as investors spread the portfolio allocation more broadly. Now, the various policy announcements from the current US administration are clearly a headwind to US economic activities, and the probability of a recession in the second half of 2025 has risen. But the US dollar has declined as investors question the longer-run outlook for the US market, and confidence on the currency has been built on a stable economy, the rule of law, and also an independent central bank. Many of these assumptions are again under challenge. It is important to recognize that a weaker dollar does not equate to a declining role in the US dollar. As we mentioned earlier, there have been periods where the US dollar was much weaker, such as during the 2000s due to strong global growth, but the importance of the dollar was never in doubt during that period. With the US dollar behaving atypically, it is worth examining its current role in the global financial system, which should not be understated. For example, more than half of global goods trade is conducted in US dollars. Specifically, it accounts for 56% of all global trade invoices, well ahead of the euro at 30% or the yen at 3%. Much of the euro's use here is for intra-regional trade within the euro area. It is also by far the most dominant currency in foreign exchange trades, with the US dollar being on one side of 87% of all currency trades, which also means lower transaction costs when using the dollar as a trading currency. And even with diversification in foreign exchange reserves by global central banks, the US dollar accounts for 58% of all reserves and down from 65% in 2016. While the diversification into other currencies may continue, there are still few challenges to the US dollar in this function. Central banks build their foreign exchange reserves to provide liquidity during times of stress, and US dollar's asset market depth and liquidity is still second to none. Overall, we don't see a viable alternative to the dollar in the short or medium term, and this will require a sizable increase in asset base for other currencies. 70% of foreign currency debt is denominated in US dollars, well ahead of that in euro, 21%, or the British sterling at 3%. In the near term, the US dollar is likely to remain under pressure, as well as exhibiting more volatilities. However, not only for policy-induced reasons, but also for market and economic factors as well. The dollar remains overvalued on some metrics. The real trade-weighted index or trade-weighted exchange rate is still over 1.6 standard deviations above its 10-year average and only just off its January 2021 peak. The US is also running a sizable current account and fiscal deficits, a traditional recipe for currency depreciation. The dollar has avoided sharp weakening so far because of investor confidence in its dominant role and also the low cost of transaction using the US dollar. That said, the revolving door policy on tariffs and subsequent impact on the US economy is challenging this confidence. A push for a weaker dollar from the Trump administration in an attempt to boost U.S. export competitiveness may also mean that the government finds a downward trend in the dollar movements acceptable. So to conclude, we don't think there's a viable replacement to the US dollar in the global financial system in a short to medium term. The near-term implications for the US dollar do appear to be on the downside, absent a policy reversal on the implementation of reciprocal tariffs. For investors, the sharp currency shifts can create unwanted portfolio volatilities, especially for those whose base currency is not the US dollar or use it as a safe haven. The dollar has not always worked as a safe haven, especially when the risk event took place in the US, such as during the collapse of the Silicon Valley Bank and the resulting banking crisis in 2023. This suggests that investors should consider a greater use of currency hedging in portfolios to reduce volatilities and also manage downside risk from currency losses. Thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues and consider subscribing. If you have any topics you'd like us to cover, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.